welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Steve Bigalow from Candlestick Forums. I think is that the right name of your business, Steve? I think so.
Yep, the Candlestick Forum.
Okay, so before we get started, quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This education is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that, I'll stop sharing and give you the ball, Steve, so you can share your screen. And you should have it now.
Yeah, I'm looking for the thing that says share your screen. It was on here a second ago.
Try the quick start menu or the menu at the top for share.
Share, okay. My screen. Ooh. Okay.
Okay, and while it's sharing, so I want to thank you, Steve, for coming on and being a guest. We're looking forward to learning more about candlestick patterns.
Okay, thank you, Tom. And let me get to the right screens.
And I'll put myself on mute just so there's no distracting background noises, but I'll still be here and jump in if you need me.
If people want to ask questions as we're going through, I don't have the screen up now where I can see the questions. If you see a question,
I will. I'll let you know.
Yeah, just blurt it out. I'll answer it as fast as possible.
All right, sounds great.
All right, so using candlestick signals has a great advantage to it for analyzing which direction a trend is moving when a reversal has occurred. So I will kind of go on the basis that not everybody is familiar with candlesticks. I came across candlesticks about 40 years ago by accident. I'd been a stockbroker with Kidder, Peabody, Cowan and Company and Oppenheimer, and got out of the business because I realized that the brokerage firms had no more idea what made prices go up or down than anybody else. Somebody laid candlesticks on my desk, and I figured with it sounding that sophisticated, it wasn't worth my time and effort to look at it. But they kept badgering me, and then I started looking into it, and kept thinking this makes sense. And the more I looked at it, the more sense it made. So I started using candlesticks, but unfortunately, they're out of the 50 or 60 signals that are available in Candlestick universe. I wanted to learn every single one of them because I didn't want to miss any trading opportunities. But I discovered that out of the 50 or 60 signals, there's only 12 that you needed to learn, which I call the 12 major signals. Unfortunately, back then, I had to learn everything I could because there wasn't anybody else around that knew candlesticks. So obviously, when you're trying to learn something, you like to get a second opinion from people. But my problem was the only time I could get a second opinion was when I'd go to the doctor. I'd say, "What's wrong with me?" He goes, "You're fat." I said, "Well, I think I want a second opinion." He goes, "All right, you're ugly too." So I had to learn the candlesticks, all of them, and then I realized that you only needed to learn the 12 major signals. And the nice thing about candlesticks is it is 400 years old. The Japanese rice traders that developed candlestick signals not only identified which signals or what the signals looked like, but they also told you what the psychology was that created that signal. So when you have that combination, you've got a very firm grasp of what's going on in a price trend. So why is price trend analysis important? Well, it's basically knowing which direction you want to be positioning your portfolio. And if you're a day trader or a swing trader, you obviously want to know which direction the trend's probably going to move in the general market or whatever you're trading based upon the next 2 or 3 days of trading. So when I'm analyzing the trend, the first important criteria is the signals. The second is the patterns. Third is where are you in stochastics? The very common sense, the Japanese rice traders say that if you're in an oversold condition and you see a candlestick buy signal, the probabilities are pretty strong that the uptrend is about ready to start. if you see a candlestick sell signal in the overbought condition, more than likely you're going to see a downtrend. We also use trend lines and moving averages to kind of act as confirming indicators of which way the trend is going. So my moving averages are the 200, the 50, and the 20 simple moving average. And the reason for that is obviously every major money manager around the world uses those moving averages to make their decisions about what they're going to do with their portfolio. The important one is what we call the T-line, the 8 exponential moving average. And I'll show that here in a minute. So when we're identifying the market, we look at the Dow, the NASDAQ, and the S&P 500. And so a lot of people say, well, why do you use the Dow? There's only 30 stocks there. Because the Dow seems to represent which way investor sentiment is going. And to look at the charts takes a matter of 10 seconds to see what's going on in each trend. So obviously, if you have an uptrend, you can see which way it's going until it breaches. If you've got a downtrend, again, here are the moving averages, the 200, the blue is the 50, the gray is the 20, and the T-line is the black one. Here's our stochastics. My stochastics are set at 1233. So we want to know whether we're in an uptrend, a downtrend, or a sideways trend, because they all have an influence on how you want to position your portfolio. So if we can identify which direction the trend is, obviously we can trade in that direction. So if we're buying calls or puts, we're buying puts in the downtrend of whatever we might be trading, knowing that the market's going to help it. What we're looking for is a reversal. And our reversal is a candlestick reversal signal and a close back up above the T-line. We also know that prices move in waves. So we can identify when those waves are being broken, or what patterns, like your pennant patterns, when those pennant patterns are being broken. We can see what's happening at the top of those formations based upon the candlestick signals. So what we're looking for is a breakout potential, and we can see that by candlestick buy signals. This is what we call the bullish harami, which in Western terminology is known as the inside day. Now we're looking at this level and seeing whether they break out. So we're buying right here. If we're buying calls or trading the stock, because what's our risk reward? The next day, if they fail here, we're back out with a very small loss. If it breaks out, we've got a good price gain. So we're looking for the breaches of a trend. There's our sideways channel. It breached it right here. We're going short. So we can see exactly what's going on in a price trend based upon what's happening with the signals. As you can see, this was in a nice uptrend, staying above our T-line. There's a very simple rule of the T-line. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line. With a caveat, the further away you move from the T-line, the higher the probability they're going to come back and test it. So if you're way up above the T-line in an overbought condition and you start seeing reversal signals, the probabilities are they're going to come back and test the T-line. You might as well start taking profits. But notice what was happening right here on this little pullback. This is why we want to know, or that we do know, what the nature of each signal is. These are dojis, little hammers. You can see how indecisive they are. They're trading right, open and closing right about the same level. That tells us that the investor sentiment up here is not very bearish. It's just indecisively pulling back, so we're waiting for the next buy signal, which in this case is what we call a left-right combo. A doji, which is the indecisive day, where it open and closes right about the same level, followed by a bullish engulfing signal, where this candle completely engulfs the body of the previous day. And what's it also telling us? Telling us they aren't going to be trading decisively below the T-line. You're still in an uptrend. So anytime we start seeing a pullback that's indecisive, we're getting ready for this next move, because this is what we call a J-hook pattern. Here's wave 1, there's wave 2, the little J-hook, and wave 3. And wave 3 is usually going to be the same magnitude as wave 1. And the nice thing about being able to analyze this is we know ultimately where our timing is for getting back into the trade. As soon as we saw some buy signals and a close back up above the T line. So we can analyze what's going on in a trend. If we're looking at the Dow on this chart, we can see that they bottomed out here with a bullish engulfing signal, close above the T line, but then look what's happening. It's just trading indecisively until it breaches this trend channel. And notice what it's also failing at, the 50. There's our bearish engulfing signal. We're ready for the next downdraft. We have different patterns. The fry pan bottom is a big rounding bottom that breaks out to the upside. A dumpling top is a big rounding top that you couldn't trade one way or the other if you wanted to until you see the big break to the downside. And when that occurs, this occurred a couple summers ago. And when it was doing this, we just told all our chat rooms to just go play golf, go fishing. That you really couldn't trade it, and until we saw the breach to the downside, which gave us big, huge profits, much more than trying to trade this area right here. But this is what we expect coming out of a dumpling top, with a big move to the downside. As far as trend channels, we can pretty much see where support and resistance are, and we can see what type of signals are occurring. Here's our morning star signal right off this bottom support level. We can also watch to see what happens at the top of a channel, whether this big long-legged doji, which shows indecision, there's a very simple rule of the doji. It's usually going to move in the direction of how they open after a doji. So if we see a long-legged doji at a resistance level and they open it lower the next day, that tells us exactly what we want to know, that they aren't going through that resistance level. So here's a time where the Dow was doing this trend channel. You can see where it was supporting. You could see where it was resisting. And it was every time it pulled back to the support level, notice the doji, if it opened positive next day, it was coming back up. But when we woke up this morning, or that morning, the pre-market futures are showing that the Dow was going to be down 140 points, which told us there was a change of investor sentiment. It was time to go short. That was at the same time that you could see the NASDAQ was a slow uptrend, and on any given day, you could have the NASDAQ up and the Dow down, which told you there wasn't any change of investor sentiment. It was just shifting funds. But then we had at the top of this trend channel, the same day the pre-market futures were showing the Dow was going to open up down 140 points. We had a bearish engulfing signal and a gap down. That sell signal and the gap down told us everybody was coming out of the market. It was time to go short. You can use the signals to tell you what happens at important technical levels. There was the breach of that trend breaking through the 50. We could see where it bottomed, and where do you think our next target was? Coming up here to test the 50 to see if it was going to go through. Once we got up here, notice all the indecision. This is what we call a hanging man. There's his head and there's his legs dangling down. A very simple rule of a hanging man. If they open it lower the next day, they're taking it down. They brought it back down to the 20, did a bullish harami, telling us the selling had stopped. This time they went through the 50. And then what happens when they usually go through a resistance level? They come back to test to see if it's going to act as support. And again, there was our bullish harami. We're buying aggressively the next day because that pretty much told us they were supporting on the 50. Same scenario over in the NASDAQ. Hanging man pulled back right to the 20. Doji, hammer, gap up again through the 50, told us the uptrend was going to be in progress. Anytime we can see where there's a kind of a trend and where the resistance level is, again, we got a bearish engulfing signal. This one's called a morning star signal. A big up day, a day of indecision. And the third day closes more than halfway down that candle. And look where it closed, below the 50 and below our T line. So essentially, this downtrending channel also told us we had to close below the T line. We stay short until we see a candlestick buy signal and a close back below the T line. However, Notice how far away it started moving from the T-line down here. That told us to be aware or get ready, especially in the oversold area, for a reversal. So we're starting to take profits down in this area with the anticipation the first target is going to be a bounce back up to the T-line. Failure right at a resistance level. Failures right at the resistance level. Evening star signal telling us we're heading in a downtrend. Now, is this a reversal? Well, we're starting to see some buy signals, but what was our criteria? We're in a downtrend until we see a candlestick buy signal and a close above the T line. So this didn't scare us. However, a week later, now we have a close above the T line, stochastics in the oversold area. That tells us if we were short, we better start coming out of that trade. So very simple rule of candlesticks. If you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. This is what we call 45 degree. Notice how we broke out of this kind of fry pan bottom. They gapped it up. All we have to do now is stay long as long as we don't see a close below the T line, which was up here. So basically keeps us, even though we might be seeing some selling, it's not confirmed selling until it closes back below that T line. Now, the reason the T line is so effective is the other moving averages act like magnets because everybody and their brother has these on their charts, watching to see whether they're going to support or resist at those moving averages. Nobody has the 8 exponential on their chart. So with it working so effectively, it basically boils down to that if the candlestick signals are the graphic depiction of what's going on in human nature, and the T line acts like a natural support and resistance level, like a Fibonacci number, when you add those two together, that combination makes for a very powerful trend analysis tool. So when you have trend channels, you can see exactly what's happening at the tops and the bottom of the channels based upon what's happening with the signals. If we can see this trend channel developing, and we got morning star signals and a close above the T line, that tells us our next target is probably back up to the top of that trend channel. And when we get there, what type of signals do we see? Indecisive trading, resisting at that level. We're ready to take profits, looking for the next move to the downside. So we can see which way a trend is moving and see what's happening at important technical levels that everybody else is watching. So if I see a Dow and I can see that there's a potential top, bottom, failure, if I can start drawing a parallel line, I'm looking for this move here, come back down to the bottom of that trend channel. I start watching more diligently to see what type of signals are happening. Again, the indecision, close back up above the T line. We're closing out a short position and it's going long because where's our next potential target? Up here at the top of this channel. When we get up here, again, what's our basic rule of the T line? The further away you move from the T line and you see a sell signal, there's kind of a bearish harami. If it opens lower the next day, it's confirming the signal, and where's our next likely target? Probably back to the T line. So that pretty much confirms that this level has failed. We're starting back in a downtrend until when? Until we see, again, a strong morning star signal that bottomed out here at the T line. The doji, you can see, hit right smack dab on the 200. And what's our simple rule of the doji? It's going to move in the direction how they open it after a doji. As soon as we see how the pre-market futures are positive, we're buying aggressively, anticipating what our next price move is going to be. So as soon as you can develop a trend channel, it gives you at least a target, and you can see what's happening at that level when you get to that target. You can see there was bottoming action. Where's our next price target? Probably heading back up to the top of the trend channel. Now, does that mean it's going to get there? That's our projection. However, the most important criteria for candlestick signals is the signals themselves. If it comes up here and we see a drastic sell signal, we've got to assume that's not going to go to the top. We take our profits early or reverse our positions. So essentially, when you hit a support and resistance level, we can see exactly what type of signals are happening. Notice when it came this wedge, we had a big bullish engulfing signal. And what did it tell us about this trade? Our stochastics hadn't come back to the oversold area. That tells us there's a new force here. We're getting ready to watch Netflix break out through that wedge formation. So it gives you the ultimate timing that if you're an option trader, that you don't have to sit around waiting for something to happen. You know exactly when the breakout should be occurring, and you can be buying based on the signal and a breakout of a resistance level. So if you're trading the E-minis or the YMs, you can see what you want to be doing. If this was a trend channel and they breach it right here, that tells you there's a new dynamic. You want to be going short on the YMs until you see a buy signal and a close back up above the T line. So not only does it tell you when to get into a position, but it gives you good target projections of where this price move should move. This is what we call your best friend signal. Best friend signal, you're in the oversold area, you see a doji followed by a gap up, call that your best friend because not only will it produce an extremely high probability of a positive trade, but it will usually indicate there's a lot of force in that trade. You're going to probably be going much higher. There's our fry pan bottom breakout right here at the resistance levels. There's where we start seeing indecision. There's where we start taking profits. And now what's our next likely target? Could be back to the 50, back to the 200. You could throw your Fibonacci numbers on here. Anything that tells you where your target might be. The advantage you have with candlestick signals is it's going to show you exactly what investor sentiment is doing once it hits one of those targets. So if I can see a trend channel or a resistance level, and I can see sell signals and a close below the T line, where's my next likely target? Back to the bottom of that trend channel. So again, this is not rocket science. This is, I tell people that all you have to do is be able to see, and you can use candlestick analysis. And I kind of equate it to the old couple that are getting ready for bed. And she's standing there naked in front of the mirror, and she says, look at me. My face is wrinkly. My arms are scrawny. My butt's spindly. My legs are thin. She turned around to her husband and said, is there anything you could say that make me feel good about my body? And he goes, well, your eyesight's still pretty good. So as long as you can see, you can analyze what's happening with candlestick signals at important technical levels and where your next target might be. Again, the resistance level, where it topped out before, and we started seeing sell signals. Notice the indecision up here. Notice the little, what we call a tweezer top. They couldn't get above that level. When they started selling it off, especially with a doji gap down, your bearish best friend, where was it heading? It's probably heading back down to the bottom of the trend channel. And when it gets down there, basically look to see what type of it's going to support here, because we can see exactly what the investor sentiment is when it gets to that level. Whether you're trading currencies, stocks, bonds, soybeans, tulip bulbs, anything that has fear and greed, candlestick signals are merely the graphic depiction of what's going on in investor sentiment. These were potential sell signals, but what didn't they do? They didn't close below the T line. We had more sell signals. Indecision, a bearish engulfing signal, kind of a doji sandwich. A doji sandwich is one of the simple analytical tools that we use. You have a big down day, you have a doji, another big down day, and this down day and this day are usually going to be the same magnitude, and it usually represents there's going to be more downside. So once we started getting up here and we started seeing the doji sandwich, we're taking profits, especially if it opened and started trading below the T line the next day. Just gives you a very simple exit strategy. Again, there's our fry pan bottom, and where did it break out? Right where the fry pan bottom, you can see this big fry pan bottom, which is usually a buildup of investor sentiment. And the nice thing about the patterns in candlesticks is it didn't matter what the market in general was doing. This pattern was telling us if it broke out, especially here and the 200, told us we were going to have a very strong price move. How long do we hold on to this price move? Until we see a sell signal either too far away from the T line or a sell signal and a close below the T line. We're short lean hogs right now. You can see what the trend was, and you can see what happened once it came back up to the 50-day moving average. It came up very indecisively and then had a bearish engulfing signal. So if we were covering our short positions right in here, we were reshorting here, and we're still short. As a matter of fact, this candle right now is down about here, still short this trade. And it doesn't matter what time frame you're using. If you're a day trader, the candlestick signals work just as effectively on a 1 minute, 5 minute, 10-minute chart combination as they do for a long-term investor that's using the daily, weekly, monthly. It's candlestick signals are the accumulative knowledge of everybody buying and selling during a particular time frame. There's a big evening star signal. And where did it occur? When your stochastics were up here just getting into the overbought area. And what was the criteria here? A big candlestick reversal signal and a close below the T line. So even if you were intraday trading, that became the time to go short on that trade on a 10-minute chart. So the analysis of the overall markets are very simple. The signals work just as well on a market index as they do individual stocks or anything else you're trading. There's our evening star signal. Notice how far away it had moved away from the T line, and look where we were in stochastics. If it opened lower the next day, where was it likely to move to? Back to the T line. What's the worst case scenario if you got out here? If you saw them buying and doing what we call a J-hook pattern, you could always buy back in. The fact that they closed below the T line told us we're probably heading for our next target, which is either the 50, and if it didn't hold at the 50, which we saw it didn't, and it never got back up above the T line, we're heading for the 200. What happened when it got to the 200? There was our doji, big bullish morning star signal, close above the T line. We could stay long until we saw a candlestick sell signal and a close back below the T line. Once we start seeing the selling, now we know probably what's likely to happen. It's probably going to drift sideways until you get to the 50. So right now, we're seeing the market ever since July just has been sideways. And notice earlier this summer, the sideways was based on that they didn't move the markets at all. It was opening and closing right about the same level, dojis, little hammers, little inverted hammers, not moving anywhere. And one criteria we could see was the market was moving sideways. And then they broke this level, but now what's happening? You can see there's up days, down days, up days, down days. We're still moving absolutely sideways. I think right now the Dow's up after being down big yesterday. So obviously the analysis of the market trend hasn't changed. We're still moving sideways. Now, that doesn't deter us because we can look at individual stocks like Ren. Notice Ren came out of this little fry pan bottom, broke out. We took profits here, we got back in here. Took profits here, got back in here. So what candlestick signals basically do for you is they tell you when the probabilities are for time to get out, and they tell you when to get back in. Now, this kind of eliminates or reduces the emotions of trading. I always mention to people that I was the worst investor in the world before candlesticks came along. I was even a stockbroker for 8 years. And it's because I did everything that normal humans do. If I took profits here or they stopped me out here, I wouldn't get back in because they're not going to trick me, get me back in and then take some more profits from me. But now I know what human nature does. I know what happens after a strong price move? Some indecisive trading, and if it starts coming back up, there's our left-right combo, a doji followed by a bullish engulfing, which is a very strong reversal signal. We're starting to buy back again, and we stay long, took profits here, and bought back here. So I'm not worried about maximizing my profits. Whoops, didn't want to do that yet. On this trade, if this is a 10-point move and I only get 8 points of it, but I know every time I'm in it, I'm heading in the right direction without the risk of it pulling back, that's fine with me. Essentially, what the patterns do is tell you what's happening in human nature, and this is what fry pan bottom, this is what they were trading in the trading room yesterday, because it broke out right here at the beginning of the fry pan bottom. Do we always get big price moves like this on a breakout? Definitely not. We'd been happier than a pig in doo-doo if it had just done this for the next 2 weeks. But what candlestick analysis does is it puts you in positions where the probabilities of being in the big price moves are greatly in your favor. So again, this was a fry pan bottom, breaking out right at the right time. So not only does candlestick signals tell you what's happening, it's telling you precisely when to enter a trade, so you're not having to sit around with your money tied up in situations waiting for them to happen. So this is your classic pattern. There's what we expect coming out of a fry pan bottom. When it breaks out, you get a big price move. This is your J-hook pattern. We recommended this stock this morning on the positive open because a J-hook pattern prerequisite is a strong price move followed by a pullback. Notice how it kind of just hovered around the T-line. Now it's gapped back up. That told us wave 1 and wave 3 are probably going to be the same magnitude. So even if you miss this move, which was, let's say, a 4.5-point move, you can pretty much calculate that from right about here, you're heading for about 11.5, the same magnitude move as this. So the benefit of candlesticks is you can utilize any other indicator to improve your trading prospects because you know exactly what's going on in investor sentiment at those important technical levels. And you don't have to use formulas. You don't have to use price percentages. It's just common sense visual analysis of what's happening in human emotions. A lot of people tell me they're money managers, or somebody said if you buy something and it's down 6%, 4%, 8%, close out the position. The problem with that rationale is the market doesn't give a hoot where you bought. The only thing that's going to be the analysis is what is that chart telling you. So even with, because candlestick signals tell you when to buy, they also tell you when to get out of a bad trade. So it shows you where to put your stop losses and kind of takes the emotions out of your trading. So that's because candlesticks are the graphics of the most consistent indicator in the world, and that's human emotions. So again, I was the worst investor in the world. I got out of the business, but when candlesticks came along and I learned how to use them, which didn't take very long, I pull money out of the markets consistently just because I know every time I put on a trade, the probabilities are going to be in my favor. So that's about all I've got.
We have some questions for you, Steve. Yeah.
Okay.
Gabber asked, have you seen the reliability of these indicators change over the course of years, and if yes, in what way?
No, because human nature does not change. I mean, the Japanese rice traders that developed this 400 years ago didn't become wealthy. They became legendarily wealthy. They were the powerhouse, financial powerhouse in Japan for centuries. And it's because human nature doesn't change at all. Now, my biggest problem when I was before candlesticks came along was my emotions just whacked me around, and I every time I put on a trade, it was because my mental intellect, which was greater than everybody else's, said this price should go up. And when the price didn't go up, it was because everybody that wasn't as smart as me didn't see the rationale of why they should be buying that stock. And I would hang on to it way longer than I should. Now I know that the probabilities of being in a candlestick trade is going to be extremely high. So even if I suspect that probably about 70% of my trades are going to be positive. Now, it may only be 0.3%, it may be 300%. But the other side of that coin is I now have come to grips that if 70% of my trades are positive, which is a good correct trade ratio, I also have to realize that 30% of my trades aren't going to work. So that comes into the factor that if I see a good bullish trade setup and next day it negates, I close out the position and move on to something where the probabilities are in my favor. All right, what else you got?
Okay, Jim asks, can you comment on the usefulness of the Heiken-Ashi candlestick charts?
Heiken-Ashi is kind of a vanilla down charts. I helped write some of the formulas for Heiken-Ashi. It just it's I want to say it's kind of moderates. You can use it for longer term trading. It's not useful for any short term trading. The most effective indicator that I have come across, and again, we've had John Bollinger talk a few times on our chat room. We've had every technical indicator you can think of. If you just put the 8 exponential moving average on your chart and use that, I mean, I was making good money with candlestick charts without the T line, but once I put the T line on, it kind of dramatically improved my profitability and not whipsawing me in and out of trades.
Is the term T line, is the T short for something?
Yeah, we were trying to figure out a name for it. We came up with target line, trigger line. So just to shorten it, we just called it the T line.
Makes sense. Gabber asks, do you use volume/market profile in addition to candlestick analysis?
No. We're buying price. A lot of people say, I want to see the volume go up as the price goes up. Volume has absolutely nothing to do with price. If the price is moving up and nobody's willing to sell it to you and people are willing to pay for it, it's going to go up on low volume. Now, the only time we do use volume as an added indicator is if you see a bottoming action happen, like a big long-legged doji in the oversold area, and there's huge volume, that's added confirmation that there's probably been a lot of change of ownership where the smart money has now bought up all the position from the panic sellers. And that's kind of the basis of candlestick signals, is it shows you where the panic selling is occurring graphically, and it shows you where the exuberant buying is occurring. So knowing that, all I had to do when I started learning candlesticks was realizing I was usually the panic seller there at the bottom, and I was usually the exuberant buyer at the top. So if I just shifted around and said, all right, up here where I'm starting to see a sell signal in the overbought condition, even though everything looks rosy, I should start looking for sell confirmation.
And that's it for the questions, but I have a question. Do you have more information about you mentioned the chat room, or what do you guys do over at Candlestick Forum?
Oh, we've got 2 chat rooms. One's an option trading chat room, one's which has maybe 30 people in it. And then we've got our main chat room teaching people how to use candlesticks for all trading, which usually has 150, 200 people in it at any one time. But we've got people in there that have been using candlesticks for years, and so they're a good source for finding trades, both in the options room and the regular room. Now, I also put out 2 or 3 stock picks every day, with a video to show why we're recommending it. And we go on the basis that if we don't want to just tell people what to do, because if you just tell somebody and they don't understand the reason for it, it doesn't do them any good. It's like the cop that's standing on the street corner and he sees this car weaving down the street. He blows his whistle, pulls a guy over. The guy is drunk, but he looks in the back seat and says, "There's a penguin sitting there." He goes, "What the heck are you doing with a penguin in your back seat?" Drunk said, "Oh, I found him out on the street and I don't know what to do with him." And the cop said, "Well, take him to the zoo." And drunk said, "Oh, that's a good idea. I didn't think of that." Well, the next day, the cop's standing on the street corner. Here comes this drunk weaving down the street again. Blows his whistle, pulls the guy over, looks in the back seat, and the penguin's sitting there. He goes, "I thought I told you to take the penguin to the zoo." And the drunk said, "I did. He liked it so much today we're going to a baseball game." So if you don't understand why you're doing something, that's why our whole website is a training website. Again, I put out 2 or 3 stock picks every day. Again, just so people have something to continue their education by seeing graphically why it's being recommended. I do a Monday night session for members where we go through what's trading well, what the markets are doing, which patterns are setting up on different stocks, whether gold, crude oil, or anything else is influencing that sector. I do it for free for everybody on Thursday nights. What else do we do? We do also do trainings. We've got probably 30, 40, 50 training videos where people can see different aspects, either the stop losses or the entry strategies, scanning techniques for finding the best trades. We've got that on the website. And so that you don't have to always just use the training videos. Usually once a week, we would do a special session live showing people how to use the scanning techniques, or where the best entry strategies are, which patterns are the best, producing the highest profits. So it's, again, we're a constant teaching, website, showing people how to use the common sense that's built into candlestick signals.
Makes sense. We did have one more question coming from George. He says, any intention of integrating Ichimoku clouds charts into your candlestick analysis?
I'm working on that right now. The only problem is that the cloud is a good confirming indicator, but that's all it is a confirming indicator. I mentioned it to our chat room whether we needed more information on the cloud, which I'm trying to do a video on it right now. But they most of them said no. The effectiveness of the T-line and the signals are as plain and concise as you want to get. Again, it boils down to that every time you see the setups, which is stochastics in the oversold area, a candlestick buy signal, a close above the T-line, the probabilities are extremely high that you're now in the right direction until you see a sell signal or a sell signal and a close below the T-line.
Very good. Well, Steve, I think that's it for the questions. So I have to thank you for coming on and sharing your presentation with candlesticks. Very interesting.
All right. Well, thank you for having me, and hope to see everybody in the chat rooms.
All right. Well, thanks everyone for coming. And thanks again, Steve.